everybody's money is green. And to the degree which it costs you 6%, 8%, 10% equity, 12% equity, those are just numbers that move around. Then the question is, all right, what else can that partner bring? What else can they unlock? Are they pleasant to be around? Do they add value behind the dollars? And if we get in trouble, because businesses get in trouble, are they going to roll up their sleeves and are they going to behave nice when we have to say, I know you've got equity in here, but I can't afford to pay you the debt because we got into some trouble. Will you stand down for 6 months while we fix the problem?
Welcome to the Value Factory Podcast, brought to you by OneAccord. We're all about helping businesses thrive and grow through leadership, strategy, and meaningful impact. Now, whether you're a seasoned executive or just starting out, our goal is to provide insights and inspiration to help you navigate your journey. Thanks for tuning in.
All right. Mr. Craig Dickens, it is so good to have you on the Value Factory. My man.
Awesome to be here. I've been looking forward to it.
Excellent. Well, what I'm hoping that we will talk about today is ways in which you've helped owners, founders, entrepreneurs successfully exit. That's what you're doing these days at Merit Investment Bank, but it's also something that you've done yourself personally. So why don't we start with just an intro of, who's Craig, and, in a 3 minutes or less, how did you end up at Merit Investment Bank?
Yeah, long journey because I got a few gray hairs, but I spent about 10 years, maybe 12 if I add it all up, in corporate, a couple of different companies, and then got bit by the entrepreneur bug, which is kind of code word for I don't make a very good employee, right? Figuring out that if you always think you can do it better, the world might just give you that chance, right? So went on a tear for about 15, 20 years of being a serial and parallel entrepreneur, serial one after the other, parallel, maybe even a couple at a time, right? So that was a lot of fun, taught me an awful lot, and had some great wins and some scars on the back along the way, right? That every entrepreneur goes through. And after I sold my last company, and that was after 13 exits of different businesses, I said, what am I going to do next? Right. And I didn't want to, I was an operator and I was in capital intensive businesses where I kind of let it ride and rolled it into the next one. But, didn't really feel like having personal guarantees and all those things that went along with that entrepreneurial journey and putting my house in hock, that sort of thing. So I said, how can I take this education of starting 7 companies, buying 7 companies, and on those 14 companies, I added on 22 other bolt-on or add-on acquisitions
Wow.
along the way. So I hired some great investment bankers and some not so great investment bankers, and to help me with all of that. And then I ended up doing the last few on my own. And the last exit was actually, I ran the whole process, which I wouldn't recommend because it's pretty stressful and you're not always objective. But at the end of the day, decided to open the investment bank in 2013 to really, on the one hand, give back to entrepreneurs and say, look, there's a rational way to do this. And there's a way that if you think of your career, so many entrepreneurs are focused on grow, grow, grow. But there's a time to harvest, right? You've got to get out somehow, right? You can't just leave
Mhm.
this thing perpetually on, running. And a lot of people look at as kind of the last box they check to say, I have been a complete CEO or I have been a complete entrepreneur. I've grabbed the brass ring. I've monetized my life's work. So I really get a kick out of helping people do that and teaching along the way because we're usually working with first time founders or, family businesses that haven't exited.
Yeah.
So yeah,
That's
it's
so,
been awesome.
so interesting. I mean, you've been through this. You said 13 exits.
Yeah.
There was 7 companies in there. Were those companies you started or bought? I mean,
Yeah.
what's the
So
profile there?
14, including Merit Investment Bank, which is obviously still running.
Yeah.
So 13 exits. And of the 14, 7 were pure startups from zero
Wow.
revenue.
Yeah.
7 were acquired companies where I went out and bought the company. And then on those 14, some didn't have any add-ons at all. Some had 6 add-ons, right? So, but a lot of other M&A to really crank up the organic growth, right? The organic growth is moving at this line, and then we add the inorganic or the M&A, and now we're taking these step functions in growth, and that really got us to some nice exits. The largest of which was about 125 million in enterprise value.
So most entrepreneurs will exit the company they founded. They'll have one exit in their lifetime. Most founders, entrepreneurs will start one company they take to exit. Maybe they'll start a couple or there'll be a few iterations along the way, but what is that one company is started as one thing, became another. I guess the point that I'm getting to is that you're breathing rare air, I believe, in terms of 7 startups, 7 acquisitions, 13 exits, 20 more. That's not many guys have done what you've done.
Yeah, I get you could call it rare air. I really call it entrepreneurial ADD, right?
Okay. Okay.
Um, and I'll give all credit. I think the guy who described the entrepreneur set the best was John Warillo, which he's pretty famous around selling circles, and he wrote the book Built to Sell. But he talks about, kind of that, he calls it the mountain climber. That's the guy like me that does this multiple times. But the largest chunk of entrepreneurs are those folks that are kind of industry experts, right? They
Yeah.
they have one company, and maybe they started as the best welder in town. And then all of a sudden they hired a guy, right? So now they're in business, right? It's not just them. And then all of a sudden they have $100 million welding company. So those folks make up about 75% of the folks that sell their businesses, which are the one time, did it my whole career. They go to the industry events, they're religious about it, right? The industry and their personality kind of become one sometimes, right? It's like it's part of their identity. And then there's others who, inherit a business, right? There's a lot of ways to become an entrepreneur. But so yeah, most of the time we're working with that 75% with the bell curve of folks that know their industry cold. They eat it, sleep it, breathe it, but they don't necessarily know how to monetize their life's work, right? So
Mhm.
that's where I've got some fun stories around.
Well, that's what I want to get into is those fun stories.
Yeah.
Our work and really the kind of the underlying purpose of this podcast is to bring conversations to entrepreneurs that help elucidate ways in which they can increase enterprise value. That's why we
Mhm.
call it the value factory. That 75% on the bell curve, the best welder in town, doesn't necessarily set out to build their business to sell it. It isn't built to sell. It's built to do something better with higher quality, with better customer service, something innovative. But then there comes a point, and you said something earlier, and it reminded me of this just the truth that every business will transition
Yeah. One way or another. Yeah.
one way or another.
Yeah.
So you've been a part of successful exits. You just shared one of which was in the $100 million plus range. Uh, let's talk about the wins. Let's give our audience something to really look forward to. If they do things right, if they do things well, what's on the other side of what do we call it? It's a process, an exit. What's the word an engagement?
Yeah, and I try to think through the lens of the client, right? And it's an emotionally packed thing selling your company. If we want to get clinical about it, it's a liquidity event, right? I'm
Mm,
taking cash from an illiquid asset, my privately held company. I can't just push, trade on the Apple stock, right? So it's a little bit, tricky to find that liquidity event. But really, in my mind, it's the keys to a lot of things, right? So it's the keys to financial freedom, it's the keys to ever increasing personal freedom. Even if you've managed to run your business and you've got a management team, you can go on vacation for a month and travel Europe and do whatever you want to do from a lifestyle perspective. Now you don't have that weight at all.
yeah.
Whether it be the liabilities, the bank debt, employees, crazy stuff happening, COVID, who could have predicted, right? So just that freedom to be able to do what you want when you want, and or even, and a lot of people associate it with retirement, and kind of the blessings of a well-lived retirement. But look, there's people that are exiting companies that are in their 30s and they just identified what the next thing is, right? What the
Hmm.
next challenge is. And we're seeing right now, we're seeing a lot of people that are like, hey, I want to get out of this because I realize the future is AI and I need to go back to school or I need to go back into the marketplace. And I need to prove things out in a new AI world. These early adopters, so to speak, which one could argue they're not always early. It's here, whether we like it or not. But yeah, there's a lot of reasons people look for that win, and some are on the positive side and some are on the negative side. Entrepreneurs, I joked about entrepreneurial ADD. Sometimes people just get bored with their company or they just say, I've taken it as far as I can take it. Somebody else needs to take it to the next level. And that requires some self introspection. And, I've seen entrepreneurs do some pretty silly things just because they're bored.
Yeah. Yeah. I'm definitely susceptible to that. I speak to myself and say no new shiny objects, Nick.
Yeah.
Don't
Yeah.
chase rabbits down trails. But let's maybe think about I saw a recent tombstone. You had a successful transaction that came across my inbox, but thinking back over some of your greatest engagements or those liquidity events that you've helped entrepreneurs, tell us a good story. Tell us your favorite story.
Yeah, so I think that one that you're referring to, and entrepreneurs fall into this, if I only had a blank checkbook, or if I only had more access to capital, I could grow this thing, or I could get into that market, et cetera. Right. So, you know, that need for capital, when we can solve that problem for an entrepreneur,
Hmm.
and most entrepreneurs think, all right, I got to go to the bank. Well, the bank only handles about 45% of the capital out there, right? In terms of working capital line of credit, long-term debt facility, whatever. But it's guys like me and others in the private credit markets that provide the rest of that capital. So that's just a recent example, and I'll walk you through it, right? That business was growing their ARR, their annual recurring revenue, but by plowing into that annuity, they didn't have a ton of EBITDA, right? Which is what the bank is going to lend against. They're going to say, all right, if you're 2 million in EBITDA, we can give you 4 million in capital, right? Two times leverage. Well, that didn't get them the ability to go buy a 5 or $10 million competitor. So we had to find a way to solve that problem for them. And I think so many entrepreneurs are feeling constrained by banking regulations and all those things that are constraints are getting in the way. So we found a structured debt and equity partner for that particular client. And they wrote a modest equity check to go on the balance sheet. And then they put in some additional debt, which would be at higher leverage ratio than the bank. So they loan them more money, flat and simple, so that they can go out and acquire. Well, guess what? Immediately, that EBITDA of the target company that they acquired will go to their balance sheet, and so now they have plenty of runway for to grow the business, combine the two, integrate, capture the synergies. So that's really just unlocking. It's a tool in a toolbox to unlock their growth aspirations. So that was a fun one, right? Where it's like you're banging your head against the wall and saying, how am I going to do this? How am I going to do this? Well, guys like you and I can unlock some of those capabilities. And that's kind of fun to see that and change companies.
The moral of the story I'm taking out of this is finding the right capital partner, and uh, that is not easy to do. Really is not. Which is why people get paid pretty well to do matchmaking. And I'll share a personal story. And you and I have talked about this uh, as a part of the succession and transition from Jeff to me. And we are, when I say we, Ariana, my wife, and I are buying the headquarters office here.
Hmm.
And given the nature of the transaction, right? So Jeff and I are 50-50 partners in the company. So our business is not an appropriate corporate guarantor for the debt for the building that we're in, because that would then create we talk about the liquidity event being weight off the shoulders of the
Hmm.
entrepreneur. Well, we're trying to affect that liquidity for Jeff in this transition. So finding a capital partner that could understand the deal dynamics and get comfortable with even just traditional bank debt financing on a commercial real estate property uh, was challenging. And I know just about every banker in town, and I'm
Yeah.
calling all my friends, and I'm doing even the initial underwriting, and I'm
Right.
showing them, here's the package, and the amount of no's or just silent, like, I don't know, Nick,
Huh?
that it took for me to find that cap. So anyhow, finding the right capital partner is difficult. Having a partner in capital markets like yourself to help find who that debt and equity and debt capital partner can be, that can see into the pro forma and understand what the objectives are. There's a lot of value in just that matchmaking in and of itself. And of course you get to be a part of advising through the acquisition,
Hmm.
which is on the opposite side of the table of the liquidity event, but still a complicated transaction.
Yeah, absolutely. And you bring up a great point. Our job is to get all things being equal about price and terms and dollars so that our clients can focus on the qualitative aspect of that relationship. Whether it's
Hmm.
finding capital or whether it's selling your business, finding the right fit is a lot of it has to do with knowing where to go and who to talk to and what questions to ask, because we all can make a decision about our gut and our heart and our head. And yeah, I like this person, I trust this person, but there's more to it, right? If you're going to be in bed with somebody for 5 years or whatever the term is, you got to pick that right partner.
Yeah.
So, and you know what? Your current partner or whoever you pick in the short run, like many relationships, you might outgrow that, right? If your business grows beyond their capacity to continue to fund you or to, pour into you or bring strategic value to that relationship. Everybody's money is green. And to the degree which it costs you 6%, 8%, 10% equity, 12% equity, those are just numbers that move around. Then the question is, all right, what else can that partner bring? What else can they unlock? Are they pleasant to be around? Do they add value behind the dollars? And if we get in trouble, because businesses get in trouble, are they going to roll up their sleeves and are they going to behave nice when we have to say, I know you've got equity in here, but I can't afford to pay you the debt because we got into some trouble. Will you stand down for 6 months while we fix the problem, or are you going to take me to court and try to figure out how to own my company? Right, there are some of those out there
Yeah,
too, right? So
there are.
really it's allowing clients to focus on the qualitative. We do all the other stuff and open up the aperture a bit based on what they think they can achieve, right? Because we can
Mhm.
bring some pretty creative ideas to the table.
How about a full liquidity of like a nice clean sale? Is there such a thing?
Where have those gone? Yeah, yeah. Well, I guess I would say, we had a client, one of my favorite clients, and really a great story. Father-son team start a company. And you've heard of the second bite of the apple, right? A lot of times when you partner with private equity, it's fairly clean, but you usually have to roll some equity and either stick around for the next bite of the apple, that second bite of the apple, or you can ride off into the sunset and their management team will take it from there. But this particular client, it was a great story. It was a fairly clean transaction. And they had that right partner for that time in the company's evolution. And it's a great story. I love it because they got a third bite of the apple and they ended up renting their facility back to the company, right? So they're got this continual bite of the apple, right? So there's really some fun things you can do. A lot of people, again, they equate sale with retirement. Well, I think, the son was probably 36 maybe, and the dad was in his late 50s. And, now he's got a second career as a speaker and an author, and, he's fully exited the company. But being able to do those things and watch that family, I mean, that transaction was probably 10 or 11 years ago, but you get to see the legacy that's created and
Mm,
what can happen with a private company. And I know you guys see it all the time when you can come in with an idea or two or three that say, you can really change the trajectory of your business and where you can take the business by making these tweaks and by focusing on the business versus in the business, right? Some mindset set changes as well as some practical and tangible recommendations and advice. Man, you unlock some things in people, right? And it's
yeah.
cool to watch for sure.
So that second and third bite at the apple, This is the boy, I don't even know what words to put on it, but that's the that's the thing that I actually aspire to do as I,
Hmm.
as I map out the future of One Accord and how we can transition from a two-person partnership to an employee-owned company
Hmm.
with some opportunity for liquidity for those employees, that becomes multiple bites at the apple. So for this father-son company, what was the first bite? What was that? Yeah.
First Bite was a partnering with a private equity firm that was clearly a lower middle market firm, and they were in the telecom business. They built towers, right?
Mhm.
Cell towers, and that partner, they were able to really put together a larger group. So that instead of a local company, now they're part of a regional, or what we'd call a super regional, because they cover pretty much half the country.
Yeah.
And then so they were able to recap that, recapitalize, take some of their equity off the table about 18 months later. And then about 3 years later, they sold the company to a larger private equity firm that was executing a larger roll up of the industry. So they got to ring the bell again after that transaction. So, a
And in
lot of
that,
times when you partner with the right folks, they can accelerate your growth,
yeah.
and your second check sometimes is as big or bigger than your first one. So it's really cool to see.
There's some lessons in here, and in the back of my mind, I'm thinking of the fact that Jeff Bezos is not the majority shareholder of Amazon, nor is Elon Musk the majority shareholder of Tesla, as I understand it.
Yeah.
I don't know, I don't remember the name of the CEO of NVIDIA, but also a minority. I think these guys are all under 10% ownership on the cap table, if whatever I read on Twitter is accurate. So for many of, I'll say, my peers, so if I'm the entrepreneur and I'm the guy that's calling Craig in a couple of years saying, "Hey, I think I'd like to have a first bite at the apple. We need some growth capital. We've got this business plan, but we could use another 4 million bucks. And the bank's not going to give it to us, and we're not going to write checks to put into the company. We'd like to take on a partner." And I might say to you, Craig, "But I don't want to give up control of my company." Right? Is that necessary? Like in this case, and without divulging too much, um, is it a 20% equity partner? Is it a 51%? Is it 80%? Like what do you see in that kind of first bite at the apple where the owners roll some equity, stay on and go for another one?
The beautiful thing about the US capital markets is that it is as creative as the day is long. So it used to be a bunch of private equity firms. Let's start at the top. If you sell to a strategic, chances are they're going to want 100% of your company, unless it's a joint venture or some stage transaction. But for the most part, you kind of cash in and they go, "Oh, we'll take it from here. We love your people. We'll keep them for a while, but we've got it." Private equity comes along, and their initial mantra was, "Well, look, if we're going to put capital at risk, we're going to want to control it." So
Hmm.
a controlled investment and a full buyout typically would be in the 80%. And because you want that entrepreneur to pick up your phone when you call, because you're a financial guy, you're not an operator, you have them roll back into the deal 20% of the transaction. Now, as the markets have matured, there's folks that just do minority deals where they don't want a control position. They just want to deploy capital and be somewhere from, it's got to be meaningful. You even watch Shark Tank. Somebody comes in with a valuation and they want to sell 5% of their company. It's like, look, I don't get out of bed for 5%. But by the same token, 15 to 49% could be pretty meaningful. So
Hmm.
there's been a lot of growth in the minority recapitalization or minority investors, and it gets more creative from there. There are folks that if you're talking about debt, there are folks whereas the bank will say 2 times leverage. There's other folks out there for a premium for 10, 11, 12, 15% interest if you're really growing fast, right? They will loan you 3, 4, 5 times leverage because your growth, and you have to prove that you're going to grow at that level, can kind of outrun your debt service. So there's a lot of ways to skin the cat and a lot of ways to achieve what you want to achieve as an entrepreneur. Doesn't always have to be full buyout or even, control buyout or minority, but it's again finding that right fit and the right capital structure for what you're trying to achieve. I was having a conversation with an entrepreneur. He's growing like crazy. He's kind of like he's the dog that caught the bumper, right? Chasing the car, and he's like, "Oh,
Yeah.
now what?" Right?
Yeah.
So he's thinking about selling equity in his company, but really what he needs is working capital
Hmm.
because his customers are Lowe's and Home Depot and these big monsters, right, that are taking his product on. And of course, they start with 100 stores and then they're like, okay, we want to go 300 and then nationwide. And now all of a sudden you need 2 million bucks in inventory just to satisfy the demand, right? So being able to counsel folks and say, I appreciate the fact that you want to sell equity, but that's really expensive for you. Let's
Hmm.
find another less expensive way. And some of that can be operational. And I know you guys do a lot of work in this area to say, you might want to think about doing a business model change or a slight variation with your vendors or,
Yeah.
compress your cash conversion cycle or, there's a lot of tools and levers that you guys can pull. Um, and even on the sales side, right, to help entrepreneurs solve those problems. Whereas they're sitting there going, if I only had access to capital or if I could only
Yeah.
negotiate some different terms, right?
Yeah. It's a good segue into a question I was wondering if I'd get to ask you, which is why might you send someone our way? So, just for context here, uh, entrepreneur calls Craig. Hey, I hear you're the best investment banker in town. I'd like you to sell my company. And you have a conversation, two, three conversations. And at some point you say, I think you should go talk with the team over at OneAccord before we try to take your company to market. What would what would cause you to do that?
Yeah, I mean, there's so many thoughts here, but I'll try to be succinct. I'd say on a macro level, most are operating at the top of their game, meaning they had a $10 million company. Now it's $30 million company. They've never run a $30 million company with $30 million company opportunities and problems.
Hmm.
So what we look for in an entrepreneur is somebody who's coachable and teachable. Because if they know everything and they've got it all figured out, but yet their competitor is twice as profitable, growing twice as fast, and they're not willing to accept that outside advice, then I don't care what they want to do or how much they want us to pay us to do the job. They need some help and even some coaching to say, I'm going to be wise enough to take some outside counsel because not every company is sellable. Not every company is valuable. And because it's valuable to you, because it put your kids through college, it's afforded your second home in the mountains and your toys in the garage and all of those things. It's a lifestyle company. It's very valuable to you, but there's a difference between being valuable to an acquirer or to what we call institutional capital. So once they can say, okay, I might have some gaps in my plan or I might be at the limit of my ability, that's the first checkbox. And I said, because I don't want to send you a problem, right? I want you to send somebody that is going to listen and take the advice because it's worth more than you charge, right? That's key. And then it all starts with that client of what their timeline is and how much their organization. And I know you guys are very generous relative to here's our recommendations, here's what we think you should do given our experience. Now you can go do that yourself, Mr. Client, or you can have us help you and the smart ones usually do a little mix of both, right? Because they have some skills that they can unlock and some people on the team that are looking for, just to take the advice and run with it. But if they're smart in those areas where they do have those gaps, they let you guys come in and fill those gaps, as well as turn the knobs and dials to really get the organization what I'll call bulletproof for an exit, um, which has a lot to do about balance because if you're really strong in sales, but your finances are a mess, right? And you've got poor accounting, that's a problem. So, how do we find
Yeah.
balance there? And you guys are really good at looking at the whole business and saying, here's the bang for the buck, here's the areas that you need to kind of shore up. Um, and really kind of giving them the keys to the castle and or coming in and fixing it if they're on a faster time frame, or if they don't have the skills to do it internally. The other part of that is, you know 90% of owners think their company is more valuable than it really is. And
Yeah.
so when there's a gap to be bridged, when you talk about value, right, and value factory, if I think I'm worth 30, but the marketplace says I'm worth 20, and I'm grumpy at my investment banker for telling me it's only 20, well, you have two things that you can do. You can be mad for a while,
Yeah.
or you can fix it, right?
Yep.
Or you can drop your expectations and say, all right, lesson learned, I'm really only worth 20 instead of 30. Or I can call OneAccord and say, get me to 30. I'm willing to do what you suggest to get there. That's a great sweet spot for us sending people that have that mindset.
Well, I appreciate all of that, and I appreciate the folks that you've entrusted us with to get ready to bring back to you to take to market. I wonder about a story that where you might have had a there's two things I'm digging for here. One is a positive surprise. So I'll make up numbers. You had a company that you thought you could sell for 10 million and you ended up selling for 12, or some order of magnitude there. Or um, I'm sure in your experience, there's an operator or a leadership team where at some point in the deal cycle, something was about to go sideways, but this leadership team or this operator corrected it and brought it back. You know,
Hmm.
like as the investment banker, you're having one of those oh no moments, like this is where it could all just fall apart, but it came back. So I wonder if those
Yeah, I'll start with I'll start with the fun one. We had a software company. They were what I'll call a puzzle piece acquisition, whereas it turned out that it was a puzzle piece to a larger company that needed what they had.
hmm,
One of the things we were able to uncover is, when you talk about selling a company, it's a sales effort, right? But there's an axiom in the M&A business that companies are bought, not sold. So despite our ability to sell our tails off, you got to have a willing buyer that sees a lot of value there. And so we thought this company would trade anywhere from 25 to 35 million. Well, we went out to a wide array of buyers, and we got one in particular that was a platform company of a large software private equity group. And it turns out that that platform or portfolio company needed, and we uncovered the need that they had, and nobody else could fill this need. So all of a sudden, we kind of reached in their pocket a little bit and said, if we sell to somebody else, this could probably set you back a ways because this sounds like what you need. And we knew that they had held that company for a while. So private equity has to turn the dollars over and sell at some point, and we were that quintessential puzzle piece.
hmm,
So the deal team on that, basically short story long here, we sold for over 60 million.
whoa,
The entrepreneur was very surprised and happy. Here's the wrinkle though. He was not really emotionally ready to let go, despite the world beating double plus expectations, right? And he lived a very modest lifestyle, etc. But he wasn't emotionally there. And we literally had to counsel him, work with him, push on him and say, look, this is a once in a lifetime offer. And the proof in the pudding of why they would pay up is that platform company, once they plugged the puzzle piece in, they sold it 9 months later and they got a huge number because they sold what was the complete
yeah,
package. So everybody won in that scenario, but we had to also kind of worry about the emotional side of our seller. And sometimes people need to take yes for an answer, right? Somebody's going to give you that much money. You're free to do whatever you want. You want to go do it again, create another company, whatever. That Kenny Rogers song, "No one to hold them, no one to fold them."
yeah,
Sometimes it gets a little hairy there.
wow,
Your second question around, there's a saying and an axiom, and you've probably seen some of my axioms, but every deal dies 3 times. I
hmm,
don't care what the deal is, and it's rare that it doesn't fit that rule. And when I say dies, what does that mean? Something is uncovered in diligence, something isn't right, buyer gets cold feet, seller does something silly in the middle of the process and freaks out, right? Whatever it is, or the bank that the buyer was working with, all of a sudden that credit box that you mentioned earlier, right? This deal no longer fits the credit box, so we're not gonna fund the debt on the deal. So, I mean, we've got dozens of stories around that, and some are self-inflicted wounds from entrepreneurs who are, and I'm one, so I'm a touch crazy, right, when it comes to entrepreneurial risk taking and all of that. But we had one seller who forgot to mention that 25 years prior, he got in selling his family's business, he got dragged into a fraud lawsuit, even though he wasn't a part of it and all of that, but they ended up settling it. So no admission of guilt or whatever, but he forgot to mention that. And what did the buyer do? They found out about it even from 25 years ago. They have their former FBI investigators that, if we're going to partner with these people, they want to know who they're partnering with or who they're handing a bunch of cash to. And so we had to save that deal
Hmm.
because they were gone. They're like, yeah, I'm not even gonna sniff this deal if this guy forgets to mention that. But we saved the deal. It did cost them some earnout, right? Because they didn't have earnout to that degree beforehand. So there was a little retrade there for that boo boo. So we always tell sellers, look, the deal's gonna die 3 times, but give us two fists to fight with. Disclose, disclose, disclose. Tell us
Mm.
everything. We're your priest, your consigliere, all of that, because surprises, buyers do not like surprises. And don't think you're going to get away with it. Like grandma said, it all comes out in the wash. So, but that's one where we almost had a deal fall apart because of some missteps there. So,
Those were unplanned questions and excellent, excellent examples. As we were talking, I was inspired to ask, how many transactions, how many companies, not your own, but for other clients, have you transacted?
in our history and among all of our bankers, right? Because we have some pretty senior guys on the team, approaching 300 in total.
Yeah,
So
that's a
there's
lot
a
of
lot of
stories.
stories. Yeah. Yeah.
A lot of stories.
Yeah, indeed.
I'm just reflecting on this conversation, thinking this is probably one of the most valuable value factory talks we've had. I appreciate you, Craig.
Thank you.
Yeah, and I've appreciated knowing you as a man, as a friend, as a colleague. You've given me a lot of good personal advice and professional advice. So I'm just delighted to spend some time with you, man.
Likewise. And right back at you. It's been a pleasure working with your team and getting to know you better on multiple levels. And I think one trait I think that we both kind of share and our organizations share is kind of an authenticity, right?
Mm.
We're gonna tell you the mistakes we made, and I'm gonna tell you a couple of personal ones in my deals that I'm like, man, if I had to replay that again, I would have done it differently, right? Because that's what
Yeah.
it's all about. And really, what we're bringing is maybe a little bit more know-how and a little bit of objectivity, and it's so much easier to be objective on someone else's business than your own. So
Yeah.
we
Oh
definitely
yeah.
bring that to the table and say, okay, we get it. So I think clients enjoy that we're not just stuff shirts and here's how you got to do it and all of that. We're gonna tell you our way or the highway, right? That's life's too short for that. So
Yeah, I have so much. I think the word is actually sympathy, not empathy for our clients, because I'm the type. Just my makeup is I like to ask for a lot of advice and follow some of it.
mm,
If
yeah,
that
yeah,
makes sense.
that's smart.
Um, the folks that we work with are not entrepreneurs because they make good employees. To bring it back to where you started from, right? I have an idea. I can do it better than they can, either higher quality, faster, cheaper, differently. I can take care of my people better than other people tried to say they were taking care of me. There's so many different motivators for our clients to go into business. What do you think the number one, or number one, two, and three motivators are for someone to exit their company? You kind of talked about the weight coming off the shoulders. You've said some people think of exit as retirement, but it's not so much that way anymore. why are people, when you ask the question, which I'm sure you do, why do
Mhm.
you want to sell your company?
Yeah.
What's the answer that you're hearing these days?
I think, there's pros and cons. I think people at some point, from a risk tolerance standpoint, and we've all been hit, and our stockbroker calls us and says, diversify, diversify, diversify. So, I mean, this sounds a little technical, but you're clinical. But at some point, you sit there and go, you know what? 80% of my net worth is tied up in my illiquid company. My wife's asking me, what's next and, how's it going? And she's lived, if you're a guy, she's lived with your ups and downs of the entrepreneurial journey. And oftentimes there's a shift in what's important. Could be a health scare. Could be spending more time with your kids. Could be, I really have dreamt all my life of having a place on the beach or the mountains, right? I mean, that's a recurring theme, right? So I think the motivation comes from within. And I think, as I see it, because I tend to work with a lot of folks my age, when you get more mature in your entrepreneurial career, those things kind of shift and your focus shifts a little bit. And it's not about pounding your chest. It's about the quality of your life and your relationships. Very few, deathbed entrepreneurs have said, I really wish I grind it out more at the office, right? So I think that's really a primary motivation. And it could be on the negative side. It could be tired, right? I'm beat up. I've taken on too much, right? Because a lot of times entrepreneurs, type A, dare I say, control freaks sometimes, right? They try to bulldog it all the way through versus unleashing the team. Or some of the really astute ones say, I've taken this as far as I can, and I don't think I can add any more value, and or someone else might be able to add more value. And it's oftentimes more about their employees and the legacy than it is add more value from a dollar standpoint. They want to be more defensible. They want to make sure that their employees have a job in the next 10 years when they're maybe not willing to go out and spend another 5 million bucks on brand new CNC machines, right? It's like they know that the life cycle curve is going to do this, and certainly their risk tolerance as they get older is going to do this. So they're smart and they say, you know what, now's the time. Let me give it to somebody else and let them take it to the next level, shift it from third gear to fourth or fourth to fifth.
You said something that registered with me in conversations that we have. So for context, our ideal situation is that we are talking to that entrepreneur 3 years before they want to talk to you, right? But actually we're bringing you into that conversation 3 years before, right? They're ready to talk to you. So if that makes sense. But we're having that conversation with the entrepreneur that says, I think I want to exit. I think I want to sell in 2 years, 3 years. This is the thoughtful person. Sometimes it's, I need to sell my company. Craig told me I can't. Can you help me get ready? I only have 9 months. Okay. Those guys and gals, and we just met with two women that have started a phenomenal marketing agency. And it was, this is so funny, Craig. I asked them, I said, do you know what percentage of businesses in America generate over 10 million in revenue like you have? And they didn't even have awareness of that.
Hmm.
It's in the single digits.
Yeah.
Like you're in the upper echelon of entrepreneurs. And they kind of looked at each other and like, really? Because they were so focused on their people and the culture and the business that they had created, which I could say is one of the reasons why they've been so successful.
Sure.
Now, there's other reasons too, but this was so clear as they contemplate what the next, 5 years from now, what that's going to look like. Their number one concern and conversation with us are people,
Hmm.
are people. And
Yep.
we've introduced you to a client that we're working with in kind of that 3-year ideal perfect. This is, and I'll call him Bob because I call all of our clients Bob. And Bob is that guy. He's the best welder in town.
Uh-huh.
And he's kind of an aw shucks, let's just do it right and do a good job. And he's grown a very, very nice business. And he doesn't want to be in business for more than 3 years. And his number one, like the leading question is, what about my people?
Yeah,
What
absolutely.
about my people? So I think we hear a different concern from the same client that might be talking with you because they perceive us differently. There's either, what's next? It's the house in the mountains.
Mhm.
I'm tired. But for us, that conversation is the people and what can we do to preserve jobs, create additional opportunity, take good care of them? Is there a way that we can reward them in this transaction too? Give them,
Mhm.
a bite of the apple? I'm just super encouraged by that. Just super encouraged by the folks that we talked to.
Yeah, and I'll tell you, and then the recent example, right? And not to, well, you guys do, your client success profile, right? You do your assessment, and the thing that I'm really excited about as I partner with you guys on that, you're kind of, because we tend to get very transactional, like what's the business worth, and how do we get to market, and who's your best buyer, and what's the value, and all that kind of stuff. And kudos to Bob, who I got the pleasure to meet and spend some time with and be a part of that work that you guys did. You're hitting the business, you're hitting the financial, you're hitting the personal readiness and your personal planning so that you don't have an event and then regret it 6 months later, right? All of that planning, it takes some awareness for the client to say, I'm going to spend the time and energy on the planning to do it right. But you're adding some value and introducing, and let's say, this particular client, does well and has made some investments in real estate and others. But when you're talking a liquidity event, 20, 30, 40 million after taxes, somebody needs to manage that, right? It's a different strata. And if you're a guy that, bought you some Apple stock and did a few things, and then you talk to a couple times a year, it's a different ball game. So even your ability to introduce them to people that will steward the future and prepare them for the future, all of a sudden your relatives will come out of the net, come out of the woodwork and looking for money, and here's what life could look like, and help them craft that vision, because entrepreneurs are interesting animals, right? What do you do when the music stops? And are you good at sitting on the beach? Or are you good at golfing 5 days a week, right? At some point, you're like, man, golfing's a little boring, right? I want to go do something else. And I think the work that your team did, and I was fortunate enough to be a part of it, and help on the what does a transaction look like part, really prepares people for not only getting to a transaction, getting to a good transaction and outcome, and then getting prepared to live your what's next. I think that is invaluable. And we see so many people that they get, a bug under, or they get a burr under the saddle, and they're like, I want to sell, I want to sell. But yet they don't do the hard work of the personal readiness, the preparedness, etc. And then they're sitting there 6 months after and say, I don't have a plan. I mean, call it a life plan, call it a after I sell plan. But I think you guys, some of the work that you do in that aspect of it is just invaluable, and nobody's filling that holistic niche like you guys are. We're going to deal with everything, right? We're not just going to deal with your business. We're not just going to deal with your culture and your people and fostering that and unlocking some of their capabilities in getting ready. But what does the what after look like for your culture? By picking a good partner and maintaining that culture, and then what does the what after look like, for you personally? So I think that's kind of fun to watch.
Well,
Definitely.
it's fun to be a part of. We can only show up that way because we have a either a brilliant network or a network of brilliant people who are all like-minded, and I'd say values aligned, like you and
Mhm.
I are. And there are wealth advisors, attorneys, CPAs, and many of whom are, some inside baseball. They're CPAs, right? The certified exit planning
Sure.
advisors, and people who understand that there's a transaction as a part of a holistic, as a part of a lifestyle. And it is really cool to do the work that we do amongst a network of literally hundreds of like-minded, values-aligned professionals that we can bring in to serve a client, just like we've introduced you to Bob.
Mhm.
And we hope that in 3 years the plan that we draft is resuscitated twice along the way,
Mhm. Yep.
right?
Yep.
Because if we live by that axiom, every deal has a chance of dying three times.
Yes.
But we're standing right by with the defibrillator and whatever other tools that we need. Craig, it's really not just fun, but educational, insightful, enlightening to talk with you. I learn something every time. I hope that folks that have listened to this conversation have internalized something that they've heard, and it's encouraged some thought about what they're doing in their company or what they might advise a client that they serve to consider. I know I've got a couple of ideas that I'll follow up with you offline as I think about the future of OneAccord and how we're going to get to where we want to go. So just appreciate you, man. Thanks.
Yeah, this has been great. Always great to talk with you on so many levels. So yeah, for the folks out there that, it's one of those things. Part of this is a lot of people kind of fear leaning into the unknown, and a lot of folks say, I'm gonna exit in 5 years, and the 5 years becomes another 5 years, right? So I just want to leave folks with a thought that, it doesn't cost anything to have a conversation. So call Nick, have a conversation, and I think you'll be better off for it. So enjoyed it,
Yeah.
bud.
And anybody that wants to talk to you, Craig, I am happy to make an introduction. And of course, they can find you. Google's getting really good these days at finding people. Craig Dickens, Merit Investment Bank. That's probably all they need.
That's right.
Yeah.
Awesome, Nick. Thank you so much. Take care. Be well.
All right, Craig.